All right, everyone. Welcome back to Financial Advocacy Podcast. We are your hosts. I am David Kinder, registered financial consultant, chartered life underwriter, here with Kurt Gibbs and Mike Moffett as our co-hosts. Today's topic, really looking forward to. But first, let's recap a little bit of last week. We got a lot of good feedback from last week on the IOL topic, and quite actually a little surprisingly, we didn't get any pushback on any of it. So that must mean it was either really good or those people haven't seen it yet. I'm sure they will. We'll get them. I'm sure we will. Other than that, you know, we're gonna work on that part. Uh, Sorry, Mike, I had to put that out there.
It's all
But
good.
Cruel.
anyway, yeah, it's terrible. Hey, shows that we're good with each other here. So today's topic, I was preparing some material for this one, is the Dave Ramsey 12% mutual fund. And I was on TikTok about, I don't know, let's just say 3 months ago, 2 to 3 months ago, and I came across this clip. So I'm going to add this in and let's hit play.
From age 25 to age 65 or age 30 to age 70. 40 years. $100 a month. Let's put it in a Roth IRA so that it grows tax-free. And I'm going to recommend a good growth stock mutual fund that has an average annual return of 12%. I own one that's done that for over 75 years. Average. Now, some years it makes 18 and some years it makes 4. But the average annual return is about 12%.
That one caught my attention because up until I saw that clip, I just thought that he pulled that number, let's be kind, out of the air. And I thought, where's he getting this 12% from? And when I saw that clip, and believe me, I don't think about Dave Ramsey that much. He's not in my mind. I don't care, but this is an interesting topic because apparently the rest of the industry seems to care. So we're going to have a little fun and talk about it. And with that information, I didn't know how old that clip really was. Obviously, it was uploaded, but it could have been 5, 10 years ago. What do I know? I thought that's too specific to just be something made up. I'm like, I wondered if that thing existed. And so I did a search. Can't believe it, but I found the fund. And in finding it, I'm like, well, let's stress test this thing. Let's see what this thing looks like. And what's interesting that I found out about it is that this is a mutual fund that's sold by brokers. And I bring that up because you guys familiar with the ELP program that Dave Ramsey has? It's endorsed local provider. And these are people who buy into a marketing campaign where Dave Ramsey, of course, promotes himself. And Ramsey also says, go to my website to find someone who is Dave Ramsey certified or whatever it is that they're going to say. And since this is a broker sold fund, it makes perfect sense. It aligns with everything that he's doing. So, hey, Kurt, did you ever sell? By the way, let me get this disclaimer out there. We are not doing individual securities advice. We're not talking about anybody to buy, sell, hold. We're not doing any kind of analysis for any individual, but we are going to take a look at this fund and how it's presented. So with that in mind, Kurt, you and I have been registered representatives. I had a Series 7 and 66 eons ago. Sure you
Correct.
had the same. Did you sell some American funds
I
from
did.
Capital Group?
I did exactly. Actually, did that for many years, and it was kind of a staple. Excuse me, a staple portfolio back, in the mid '90s, and even probably a little bit earlier with the ICA fund and some of their top tier mutual funds that were offered through the American Funds platform. So yes.
Yeah, these are very good for brokers to sell. If there's one caveat about them, and this is on the broker's side, is that sometimes the brokers didn't get a whole lot of sales support from them. There wasn't a whole lot of kickbacks or whatever, which, strange enough, with the Department of Labor ruling and things talking about fiduciary duty, that all that stuff now has to be disclosed as a conflict of interest and other things. But American Funds really didn't engage in a whole lot of that. which was probably one reason why they kept their fund expenses so low for broker sold funds. So I want to share some things here because we found it. And if anybody's curious, we are talking about the Capital Group or American Funds Investment Company of America. So I'm going to now share my screen. It's supposed to work. And okay, here we go. And I'm hitting share. And I got the information. I downloaded it about maybe 2 months ago or so. So this is information through end of December 2022. I don't have 2023 numbers. It's probably not going to matter much anyway. But I started looking at everything under AIVSX. That's the ticker symbol, AIVSX. This is a mutual fund that's been around since, I think, 1934. And I highlighted 2 statements on their literature. And says an investment in ICA has never lost money.
It's not showing on the screen.
Yeah, Dave,
I'm sorry. I forgot to hit the other button. Here we go.
Here we are.
So this is American Funds Capital Group Investment Company of America. And I'm scrolling down here. And so the highlighted part says an investment in ICA has never lost money over any 10 or 20 calendar year period in the fund's lifetime. And over its lifetime since, apparently I was right, January 1st, 1934 through end of 2022, ICA has returned an average of 11.82% annually, averaged, compared to 10.84 for the unmanaged S&P 500 index. Well, technically the S&P 500 index is managed. It's not a daily management thing, but they do take out companies and put in other companies, and they might do it a couple times a year, if that. So it is managed. It's just not the same as we might think about it for other managed funds. So it's interesting. So Dave Ramsey is not quoting himself. He's getting the information from the mutual fund company itself. There it is. And of course, he rounds up a little bit. I mean, 11.82 versus 12, not a problem in terms of the comparison there. You know, it's immaterial.
So, well, you know, and something you kind of touched on just there at the beginning when you brought this up, David, was, you know, to me, you know, looking back at you know, things done previously, the appeal to this for the broker side of things was always the expense side of it. It was, you know, it was cheap to get into, and you know, they sold it on you know, basically the verbiage he was using there of, you know, X amount of dollars, small dollars a month, and you know, you can get into a good mutual fund with, you know, great average rate of return, and that's kind of the way it was sold. Yes and no. I mean, that's you know, $25 a month is not going to make any. It's not, you know, no one's going to retire on $25 a month. You know, putting that in, even at 12%, it's just not feasible. But yeah, it was a great fund. It was a great fund back, you know, for the purpose.
And since you brought up the expenses, I'm going to show a couple of parts on the prospectus. And I actually, if I was a registered rep, what you're seeing on the screen there, I am not allowed to do if I'm a registered rep giving the prospectus to a client. You're not allowed to mark this up. You're not allowed to bend the corners of a prospectus. You can't mark up anything. But I did because I'm not a registered rep. So I'm allowed. I'm not doing that. So here's the thing. I highlighted that part up here because when you have an A share mutual fund, and the fund that we're going to be looking at is the A share expense ratio, and it has a maximum sales charge for, and if I remember right, it's up to $25,000. I'll get into breakpoints a little bit in a moment.
It is.
Yeah, I think it's 25,000 up. Yeah, it's 5.75%. So you put in an investment of 10,000, and $575 comes out off the top. And what happens with that is that you're able to buy down your expenses. So if you look down here, you have share class A, C. Looks like there's a share class T that I've never seen before, but you never know. Anything beyond C is whatever the fund company wants to use, and whatever they want to call it. But you notice that share class A has a total annual expense ratio of 0.58. Well, what does that mean? Well, that means out of the total return, let's say you have a 10% return, 0.58% is come out, and actually comes out daily. So you're not seeing, it's not like a hard charge that comes out, but out of 10%, you'll get 9.32. That sounds right. Yeah.
4.2.
As opposed to what? Oh, go ahead, Mike.
Not it's 4.2.
The math guy corrected us there. It's
Okay, fine. You
yeah,
win.
well,
Close enough.
we know how that works. Yeah.
Again, I'm not selling it. It's okay. Now, compared to the C share class, which has no upfront cost. If we can look there at the top, we look at C and 529C. There's no upfront cost. If you liquidate your fund within the first year, there's a 1% CDSC, which is contingent deferred sales charge, which means if you liquidate within the first year, 1% of that goes back to the fund company. But you also notice that the ongoing expense ratio also has an additional 1% 12B1 fee. So your expenses are higher. So typically, for the long-term investor, A share is the better way. You're going to pay that upfront cost. You're prepaying expenses to have a lower ongoing cost. And over time, it breaks even compared to if you did a C share.
Yeah, and most people could probably relate that, to kind of the way mortgage interest works. I mean, if you want to throw it into the circle of something you can relate it to as a client, something you maybe can understand a little better. That's probably a general way to put it.
Yeah, you can buy points so that it lowers your your overall cost of the mortgage. You just pay more up front, which is exactly right. So here, this is the break point. And as we said earlier, if you put in 25,000 or less, then it's 5.75%. I never really understood this next part, but I'm not worried about that. The next column over is the more interesting part. It's the dealer commission as a percentage of that price. So out of the 5.75%, 500 basis points, that goes back to the investment company that the broker works for. And then they share a part of that with the broker. So I always explain my commission disclosures like this. This is how much is going to be charged up front. And a portion of that is shared with my firm, and the firm shares a portion of that with me. I can never get exact because we had varying payout structures depending on the month. And depending on how your total month went would depend on how much you got. So this is an instance where all I cared about was, here's the cost to the client, because that's all that really matters to them. Do I know what my commission is? No clue. I won't know it until I get it. But what's interesting on this for the A shares, and this is important because I have examples later, and I didn't want to figure out what would the net amount be after all this. So I assumed $1 million in my example, because at $1 million or more, there's no cost. There's no A share load, and that's the technical term for it. They call it a load. So when I'm doing some of these calculations, I just did at $1 million just to keep the math easy. So that's kind of how those expenses and everything works. If anybody's never looked at a prospectus, well, there you go. And of course, I did the illegal thing. I highlighted, and you're never supposed to do that. So here's the next thing I wanted to share is the Investment Company of America mountain chart. Kurt, do you ever see one of these?
I haven't seen this in many years, but yes, very, very familiar.
Brokers used to have this. This is like roughly 3 or 4 pages, all framed in the office to show off. Here's what your investment could do over the long term, that kind of a thing. And everything on here is correct, but because of how it's formatted, it's misleading. And the reason I say it could be misleading is because you're condensing all of those losses to make them look like little blips. I mean, we got 88 years of history on, and this is only on, your screen right now. Where's 2008? 2008 is, nope, that's 2015. 2008 is over here. That was, okay, I'm going to zoom in. Here we go. So 2008 was a negative 34.7 in that fund. And that's all it looked like, because they're looking at the entire history of the fund. So it feels like, oh, that's not that bad. And so I want to be careful of how are mutual funds being shared and promoted to the public, because quite frankly, a lot of the stuff from 50 years before that doesn't matter anymore. The question is, if you're putting money in now, what's it going to do going forward? I rarely sold Investment Company of America, by the way. They had the most literature, though. They had the nice the annual reports. They had the nice brochures, and it was great to walk through it. They have like I
Oh
don't know how
yeah,
many portfolio managers, 8 portfolio managers. It's a great story.
it is a great
Um,
story, and it was well thought out from a marketing perspective. It was they had a kind of a tier of 3 to 4 funds. They had Capital Income Builder in there
mhm,
was a very popular fund. They had the Euro Pacific Growth Fund, which I'm sure is
yep,
still out there and alive. You could diversify a portfolio, quote unquote, within the American funds portfolio, and really make a client and yourself feel comfortable about the strategy that you had chosen for them. And it was just good marketing, good company as far as what they're out there trying to accomplish. And the ICA fund, obviously, some great bullet points on there as far as things that have happened in our history and our timeline. But like you say, kind of gets back to a question that we hear very frequent, whether it be in the investment world or the index world with the S&P, is you know when we're going to measure things, are we going to measure it in real time, so to speak, within a time frame of when certain things are happening, or are we going to exclude certain years so that we can make that glossy look a little bit better, or how are we going to display that?
Right. Sounds like the glossy
exactly.
brochure that I talked about last week.
Yeah,
Yeah, exactly.
The
that's exactly what it was. And not saying that it's a bad thing. What we're eventually going to get to is institutional thinking does not necessarily equate to planning. And so one of the things I did, I looked at those assertions like, well, there's never been a 10-year or 20-year period where the fund has lost money. Well, let's take a look at that. Now, if I was still a registered rep with a broker dealer, first, this entire conversation would have to be sent to them for compliance, and they would not like this conversation at all. So thank goodness we don't have to submit anything to anyone. This is under free speech, and we already know we're not telling you what to do with your investments. Again, the thing is down there at the bottom of the screen. We are not telling you what to do with your investment portfolio. But I took all those numbers from the bottom of that chart and I put them into an Excel spreadsheet. If I was still a registered rep, I'd be able to use their hypothetical software and be able to demonstrate and make all kinds of scenarios based on if we had invested in the past, what would have happened if, given certain circumstances. But I put all those numbers in and I kept the color coding the same just to say, okay, if everything worked out the way they said, would that actually have been the positive growth that they assert? And each year or each 10 years, and of course I could have done it for every single 10-year period, but I think if we just did it in 10-year increments, we're fine. Each one did have a positive. So, 17.7, 11.9, 17.7, 9.8, 15.5, 15.6, 13, 8.8, that was the lowest, and then a 9.7. So all in all, it has done, if you're able to have bought the thing and left it alone, or even put more money in as you want, this is not a bad fund. We know this is a very, very good fund. The question then becomes, is Dave Ramsey's advice? Because the fund might have been good, but let's talk about what he's been in the news for, or in financial circles for, relatively recently. So let's put this one on here.
To live on 4% of your money for your nest egg to survive.
Yeah, even if you did a rate of return of 10% or something.
Yeah, and what it sets up is this guy now, he doesn't think he's got enough money. And he's already got $120,000 and he's 30 years old and he's on a plan. He's on a plan to be very wealthy and he's worried he's going to have enough money or not.
Yeah.
Because stupid people put out low withdrawal rates. Like
but
listen, if you think you can only pull off 4% off of investments making 12, where the flip is the other 8% going? Well, 4% of it went to inflation. That's where it went. The other 4% is just sitting there. So you are growing your investments instead of living off of them. I'm not destroying the nest egg. I'm not even touching the nest egg. I'm growing the nest egg by leaving 4% in there.
Yeah.
Taking 8 off of a 12 growth rate.
Go.
All right, what do you guys think of that?
Well, where do we begin?
Oh, we got plenty to talk about. But what we're going to do is we're going to actually put his numbers to the test because, quite frankly, now that we found his mutual fund, and by the way, let's back up for a moment. If any investor, retirement saver, retirement client had $1 million, there is no way a broker would ever recommend one mutual fund for the entire thing. And there's a couple of reasons for that. One is it's too easy to make it look better. And Kurt, you were talking about this. We could put together a nice asset allocation model, and I would like Capital Income Builder, maybe Capital World Growth and Income, which, by the way, none of those are the true growth funds. They're actually growth and income funds that are more focused on, domestic and international and all this stuff. But here's the thing is that if you've got $1 million, I'm not even going to bring up a single mutual fund. We're going to talk about institutional money management. We're going to talk about having ongoing assets under management fees, which is not necessarily a bad thing. But here's the difference is that, and it's so key. Mutual funds are managed according to the description in the prospectus. They are not managed to a risk profile. Whereas at institutional money management, assets under management, strategic and tactical and all that stuff, they're typically managed towards a risk profile to the investor. And so
David, that's a key point. That's a key point in that as well, because too many people don't understand just what you said, and it's complicated. I mean, it really is for the average Joe out there trying to navigate where to put money for retirement. It's a fine line with being able to understand how that works. And, if you're insistent on going that route, and obviously we believe different, but if you're insistent on going that route, then, I soon take my chance on the managed side as the kind of the straight mutual fund purchase side.
Agreed. Absolutely. And in fact, I have a statement. It's an older statement, but it showed their in-house portfolio of an investment management advisory firm. And in 2008, and this is including their fees, the most their in-house portfolios lost was 4.7%. That's in 2008. Whereas this fund, we're looking at right here, negative 34.7. I would happily pay a fee to only lose 5%. So that when and as the markets rebound, you have more of your money there to rebound with you. Now, that is a fee worth paying. But so knowing that, and by the way, here's the other part, and this is the advisor perspective, of course, is that if I sold you a mutual fund under a broker suitability standard, I get $10,000 one time, assuming, $1 million going in. If I put $1 million in assets under management with a better chance of preserving your portfolio, I get $10,000 a year. Now, pure and simple, which one would I rather do? Yeah, that's a no-brainer. I want the client in where I can also have a quality yield to advisor, especially when it's win-win all the way around. So I'm all for that, depending on how it is. So I put Dave Ramsey's money to the test here, more or less. If we put in $1 million as of the year 2000, and I picked 2000 because it was March of 2000 when the dot-com bust began to happen. And that wasn't that bad compared to other years. But I always stress tested. If we put $1 million in, what would happen to the fund? And you'll notice that I moved the bar here. I did not increase the distributions for inflation or anything. But I did show, here's what it would have been based on the end of year distribution. So you had the money at January 1st. It did what it did for the year. We pulled the money out December 31st. We began the next year. Obviously, nobody's account is going to work like that, but that's the limitations I have with using Excel. If we did it the way Dave Ramsey talked about, you're out of money in 16 years. It's gone. And why is it gone? And we're probably going to talk a little bit more about this, but it's the retirement red zone. This is about the 5 years before and the 5 years after retirement when you begin to actually take distributions. Now, we're not even showing anything as a loss before distributions. We just took distributions as of the year 2000, and we left it level every single year, and that's at 8%. Now, I decided I'm going to reverse the numbers. What if I flipped all the numbers around? This is not real life. This isn't what happened. But because we flipped the numbers around, $1 million would still last. And at the end of 2022, you still have 842,000. All because of the sequence of returns risk that no one can predict when you're doing them. We don't know what the market's going to do. And anybody that thinks they do, and this is another part regarding suitability. I mean, if you talk to anybody that works for a true investment advisory firm, a Merrill Lynch, Smith, well, not Smith Barney, they're not around anymore, but Morgan Stanley, Edward Jones, or whatever else, anybody that is a primarily investment focused, their recommendations usually have to coincide with what their economists, their in-house economists, say they can. And if they deviate from that, they have to have their own certifications to be able to deviate from that. They can, but they better be able to document why they believe what they believe. Otherwise, they're all just representatives of the broker-dealer that have certain opinions on whatever it's going to be. So it's not like, anybody has an inside scoop of, well, we think that it's going to be this and this and this. Anybody can have any opinion. The question is what actually happens. So that's based on 8%. This one would have done fine if the returns were reversed. If we did 4% of the actual returns as they actually happened, 4%, 40,000 a year. And again, I did not adjust for inflation. I did not increase them at all. Not only did you have 40,000 a year, but this account balance would have almost doubled. It's 1.9 million, almost $2 million here. If we reverse that 1 million, taking out 40,000 a year, you would have had 2.7 million. So the distribution, even though Ramsey thinks, oh, you're all a bunch of stupid people. Well, let's see. Would I rather have 1 million or 2 million or run out? Sorry, Dave. This is your fun, Dave. I mean, come on.
Well, and he's not accountable for whatever he says because he's not a registered rep or a fiduciary, so he can pretty much say whatever he wants.
Go ahead, Kurt. What were you going to say?
Yeah, that's where the disconnect and really the sequence of returns risk, comes into play so much with individuals out there that are, into mutual funds and into dollar cost averaging and things like that, because 2008, the most recent, serious market downturn that we had that was really devastating for a lot of people. You take almost a 35% drop, if December of that previous year, that was you were looking to retire in the spring or any time in that next 6, 8, 10 month time frame, there's a good chance that if you weren't actively paying attention, or if your money manager wasn't doing that for you, that you a $500,000 portfolio quickly was down in the 300s with just a day or two of negative activity within the market. So, or a couple of negative months. I won't say days necessarily, but it definitely didn't take long. And I'm sure that there's charts out there that can not just predict that, but accurately reflect the issue that you would have had if that would have been a retirement year for you. And it's it's something we talk about within our group about. It's not about the accumulation, it's about the distribution. And the industry really didn't give us any help, early on in our careers, if you will, from the mutual fund days of, we didn't talk about distribution. We talked about, we need to build you that pile of money. And that pile of money sometimes is we talk about it all the time. It's where your money is at is more important than what it earns.
Absolutely true. And what's interesting is that when we go back in time, and we were around, actually, I wasn't licensed until 2004, but I was in banking. And back then, these down years were ebb and flow. It was not dramatic. 2008, that was in a 2-month period. It was in a free fall. No one, granted, we knew something was going to come. We didn't know it was going to come like that, though. It was such, I remember I changed firms, and I remember looking at Bloomberg.com and just watching it. And this was when the market was, basically at either 14 or 15,000, doing a free fall down to 6. And I remember there were 2 specific days where they halted trading, and I'm looking at my screen and said, negative 999 points. I'm like, oh my gosh. And I'm thinking back with the clients I had at the previous firm. Are they in trouble because of me? And I had to remind myself, no, this is not my fault. I advised them properly with the information I had, but they're still in harm's way, because if they were planning to retire in the next 2, 3, 4 years, they have to wait for that money to come back. So just to show the numbers here. Now, this is including the previous year's withdrawal of 80,000, but there's a loss of 232,000 from 668. Now, if we take out the 80,000 from there, we're looking at about $150,000 loss, which is still significant, right? 150,000 lost, and we're still taking out another 80,000. This portfolio never recovered. It never went back. Now, if you were able to halt taking out the money, it usually took about 4 to 5 years before it bounced back to where it was.
And
So
David,
yeah.
that brings me to this a little bit, and I may be off a year or two on the numbers here, but 2008, if you're 65 years old in 2008 and you take a hit like this, you're what, 80, 81 right now? What has that done to your lifestyle? If you were, didn't have things positioned in, guarantees and had just played the market and just thought things were just, things were going to bounce back in a couple of months or whatever. And, things were going to work out okay. I have to believe that a lot of those people right now are not nearly as comfortable as they could have been with maybe some education as we've all kind of gotten in, the last few years on different strategies and different ways to mitigate that lifestyle change, if you will, that took place for a lot of people that they're seeing now. Not so much that they, could forecast and see when they were 65, but it's kind of where I had a turning point with what I was doing that, to your point about, feeling like you were at fault with something, knowing what we know now, I'm glad I made the decision to kind of shift my practice away from, things that were just not solid and guaranteed.
Absolutely. And for those people that were in the markets and such, the only thing you could do is take out less if you're allowed to. Now, granted, if this money was in IRS qualified plans, including IRAs, you'd be subject to required minimum distributions, which, strangely enough, what was her name? Oh, she hasn't died yet, thank goodness. Well, anyway, Nancy Pelosi, that was her. She helped to break the law for 1 year. Bend the law and say, it's the previous administration's fault. We're going to waive RMDs this year. Now, why do they do that? I think there's more of a tax incentive for the government so that they don't have to liquidate when it's low and pay less tax. They want the account to be higher so they can have more to tax on later. They figured, let's wait a year or so. Let's let this bounce back. But the solution would be take out less. Now, of course, that situation was 8%, just completely unsustainable, depending on the rates of return, the sequence of returns. The sequence of returns risk is too big. And what it ends up doing is it turns investors and retirement savers into victims of their planning. And that's a problem. I have a problem where a great plan can create victims. And through no fault of the advisor, but it's the fundamental of the advice that's given. So I want to quickly share. This is another great screen, and I share this on occasion, but it's the impact of losses. Here we go. And add to this state. There we go. So here's the thing, and this may not be quite big enough, but if you lose 10%, that's right here on the left-hand side, all you need is 11% to get back to even. I think most people's risk tolerance, they'd be okay with, if 1 year is down 10, no problem. It'll probably bounce back up the next year or two, and it shouldn't be a problem. You lose 20%, you need 25 to get back to where you were. Lose 30, you need 43 to get back. 50%, you need a 100% rate of return just to get back to where you were. And recently I saw a chart for Zoom stock, an individual stock. And we're not making recommendations here, but that stock has lost 90% from its high. And if you want to watch that get back to where it was, you need a 900% return on that stock to get back to where you were. So the impact of losses is huge. And the question is, how soon is it going to take for you to get back to where you were? So a negative 50% drop of the market. And again, this fund did negative 35% essentially. It still took about 4 to 5 years to get back to where they were. But what's really neat about what we're trying to do for our clients is to put them in a position where you can take advantage of this stuff. And this way, you're not a victim. You've got cash that's accessible in a non-correlated asset. And for anybody who doesn't know what that means, it means that it does not go up and down with the stock market. It's always available. It's a contract that you can borrow against, and you can put it into something like this when it's down low, watch it grow, sell it out after 12 months. We want long-term capital gain treatment, pay back the source, and keep the profit. That's a far better way. Now, the difference is that kind of planning is far more tactical. You have to be far more active in what you're doing with your planning, not being very passive. What is it? A dollar cost averaging is very passive. Just throw $100 a month into whatever you're doing. If you want to be passive, okay, but passivity seems to breed the victim problems of our financial planning advice. And I just don't advocate for that. I'd much rather have someone have cash in reserve to take advantage of opportunities than just go along the ride and say, well, maybe you'll be okay.
Yeah, there's just too much, the markets, and as a general rule, have just, so much has changed in the last 15 to even 20 years. And, you take just like the ICA fund, it's, you only got a handful of years before, the 20-year look back on that's going to look totally different because of 2008. And it's just, it's really unfortunate for individuals out there, whether it be through a qualified plan at work or a plan administrator saying, hey, you need to sign up for your 401k and here are their available funds. We use, Vanguard, Fidelity, Magellan, the list goes on. And, they kind of just throw that out there to you and expect you to figure all that out. And it's kind of like, the phrase that we hear, you kind of throw things up against the wall and see what sticks. But it's just, it's unfortunate. It's just unfortunate that the industry doesn't do a better job of educating and preparing its advisors to do what's really in the interest of your client better than what make mutual fund sales or the broker dealer, look better or whatever. It's just too much of it's gotten away from the client best interest, I think.
I completely agree. And one of the things is that there's the disconnect is, and I think I talked about it earlier, is that there's institutional speak and then there's financial planning applications. And I don't fault American funds and Capital Group for putting out there, hey, our stuff is earning this amount. It's a good fund, but that doesn't translate into investment advice, does not necessarily translate into financial planning advice, and particularly for retirement advice. So Dave Ramsey, I give him credit. This is a good fund, but that does not translate into good retirement advice. Their two are completely different and should be disconnected. So Dave, smart fund. Dave, horrible retirement planning advice. You shouldn't be talking about what you don't really know. That's where I'm at as the cumulative thing here. Any other thoughts? Mike, you're the lucky one here. You've never had any clients in the market. I don't think you've even had any licenses, and we joke about this, but you never had the license to help a client lose money.
Nope, I've never had a license to put a client in harm's way. My client has never lost a single penny in the market. So, that's just fine.
I would have to believe that, kind of to my earlier comment there, but those individuals out there that are say 80, 81 years old that were, lost a lot of money in 08, that if they could have that crystal ball and change things and gotten that, that 5 to 6%, guaranteed with X amount of products that do that and allow them to kind of spend money, along the way and do things differently, that they would have a much better or a much different outlook on what they've done with their money, as opposed to the way things are now, because of the market trends. And, there's so many things out there that really unnecessarily put a client in harm's way, and it doesn't have to be that way.
Well, if we go back to our past experiences, and I hope, Mike, I hope your dog isn't offended by everything we're talking about. I hear that thing back. Okay. But anyway,
No, no, she's not.
okay. But when we think back to our coming on board the industry, I first got started with a company called American Express Financial Advisors. Today they're known as Ameriprise. And when you get started with some of these firms, you want to be as comprehensive as possible, which is why they wouldn't let you get started with them until you had a Series 7, 66, your insurance license. It was all required so that you can offer, and obviously it felt sexy enough that you can offer everything across the sun. Whatever's out there, you can offer. You can be a comprehensive financial advisor. And, and that always felt good. I always felt extra pride thinking, I'm a financial advisor. I can bring everything that you could ever possibly want. I think we found that there's far more pride in being a true specialist, in knowing how we could really help a client, not just offering products and contracts and mutual funds or whatever else, but by really knowing here's how things work in the market, especially since 2008. 2008 shook everything. I did not want to help a client become a victim of my advice, whether intentional or not. I wanted a client to always be better off having worked with us than without. But ever since, over the past 20 years, there's been a whole evolution of a different way of thinking. And I really like how we can truly help people in a far better way, guard them from this, in fact, help them to take advantage of opportunities. And quite frankly, I don't miss those licenses. Partly because if I still had them, they wouldn't let us talk like this, that's for sure, and let it be recorded and put it on the internet and let whoever else listen to it as we want. They would be like, you got to submit this. They would say, not only do we not approve it, you'd have to get American Fund's approval for it. There's no way that would happen.
Well, it's exactly, just to the point you just made, that they didn't want us talking about that. And now we have the ability to go out and really share all the truth, not just part of it. And I just recently this week, I was going to share this with you guys at some point, but it's a good point to share this. Is I ran across a guy this week that I drew two circles. And you know how we feel about the circles. We all feel the same. We like being inside that one circle. Excuse me. But I drew two circles, and I put taxed. I wrote the word taxed in one circle, and I wrote never taxed in the other bucket. And I just flipped it around. I said, let me ask you a real simple question. I go, this is from 30,000 feet view, but which one of those circles you like the best? And he's like, well, I like that one. I'm like, well, the advisor you've got right now that's talking to you about doing different things with your money, and he's allocating you to do this, and this fund's a little bit more aggressive than this one, and the reward is greater if we take a little more risk with this one. At the end of the day, if that one is that's where the money's at right now is taxed, it has a bigger pile of money, but this one over here has got less money in it, but it's not taxed. Which one do you want then? And he's like, well, I would take the after-tax money if it gives me more income. And I said, that's the whole premise around what we do. We show people how to have more with less. I mean, we can show you how to spend $1 in 2 places or 3 places. And, in some instances we can, squeeze out more money than just, 1 to 2, but so many people, if you dial it down a little bit where that they can get their arms around it a little bit better and understand that it's not as complicated or has to be as complicated as a mutual fund prospectus and understanding all the different indexes they are now. We touched on that a little bit last week. I mean, my goodness, there used to be an S&P index, and that was pretty much it. And now we've got a mix of probably, I don't know, 15 or 20. We got blended. We've got uncapped. We've got 140% participation rate. We've got all this stuff that just complicates everything. Not just for an individual that's really just wanting something simple that they can put their trust in and feel comfortable about, that it's going to be there when they need it. And it's just it's just not the way that we see things now, and I think it's not the way that most people would see things if they truly understand and had just enough education on it to get, the facts out there about each of the products or each of the services they're looking to, kind of obtain from someone.
Exactly. They don't have to take on risk to have a successful retirement. It's not necessary. And so one of the things that we can share with folks is if we can show you how earning zero over a 10-year period can outspend earning 10% a year in your IRA. Would you like to see what that might look like? And we can do that. We absolutely can do that. And using the guarantees that we're talking about. So there's some really neat things that if we could change the perspective, we could put people in a far better position. And not to mention, because of where their money is, they could take advantage of opportunities
Exactly.
as they go along. You've really got more of an empowerment fund than being held hostage fund. I just made that up. I never rehearsed that. That sounds pretty good. I'd rather empower you than hold you hostage.
And the other thing is, and we probably need to have an episode on this as well, just to kind of tie some things back in. But we talk a lot about in our group about CEV, the capital equivalent value, and I think that is a very compelling, not story so much, but fact. When math is math, and that doesn't lie. And when you can present that in a way that people really understand that you don't have to make that 12% Dave Ramsey mutual fund average to do what we can do with an enormous amount of less money, if you will. That's a double negative for you there, but
I like that.
It doesn't take near the dollars, and I think we're seeing that with our clients that we're reaching out to now. About the strategy that we believe in, and that's been tested for 100+ years, and it's just been way overcomplicated and made that way from an industry perspective all the way to the advisor trying to build that huge pile of money for you that's really not necessary.
Absolutely. And with all the risks along with it. Usually there's not a problem with a big, large pile of money. It's just, what does it take for you to get there? And is that cost, and I'm talking about the risk and the cost, is that all worth it? And it all depends on when are you going to pull the trigger? When is income going to start for you? If you're within what's known as the retirement red zone, and Prudential made that, I think they trademarked it. If you're within the 5 years before and 5 years after, this is the most critical part, because the ripple effects of those decisions will last your entire retirement. And if we can help someone get into a far better position, that much the better. So I think we've covered this topic pretty darn well. I don't think we left anything on the table here either, other than I was thinking about the because David McKnight brings up this thing from Bugs Bunny, Wile E. Coyote, and he's got the little carrots, and he's turning them into little bombs. He's a, I'm so smart, super genius, right? He's looking at these little things, and all of a sudden the tax train, well, we call it the tax train, and comes and blows up the whole thing. And all he does is, I can't even look at that. He just pulls down the shade. He's just given up. If your advisor thinks of themselves as a super genius instead of actually being, in my opinion, more emotionally and more aware of the risks that can happen in retirement, I may want to reach out to somebody who might actually know a little bit more than just trying to balance stocks and bonds and trying to make a little bit more something out of what's there. So I think we'll leave it at that. Gentlemen, thank you so much. This was really, really good. Any other final thoughts?
No, I'm like you. I think we touched on what we needed to. That 12% mutual fund does exist, but does it truly do what it needs to do for you? As you pursue your retirement, it's just one size doesn't fit all. But definitely something to put some thought into if you're out there and you're considering mutual funds as a vehicle for retirement, or you're kicking the tires around on all the different products and services and opinions and different things that are out there about ways to save and preserve money and spend money. Then take a deeper dive into what you're looking at first before you just believe what a radio talk show host has to say about it.
All right. Well, we're out of time. Thank you, gentlemen. We will be posting this momentarily. We'll see you for the next time. Thanks so much.